up, everyone? Welcome back to Financial Education and Business. I'm going to be covering HIMS, just go over now that it's going to be part of the S&P 600 SmallCap starting October 2nd. Before the market opens, what is going to be the outlook, right? This is amazing news. The news came out October 4th. That was Friday after the market closed. And so what is the expectations, right? We're going to see a lot more interest from the public, from researchers, from long-term investors, right? The index that track this S&P 600 are going to have to buy HIMS stock, and the creating additional demand for the stock. We're going to see passive investment vehicles like the indexes that track it. They're going to have to buy it and just kind of hold it and keep it as part of their portfolio because they have indexed to this fund. More stable long-term shareholder base when you have strong shareholder base and large institutions that buy it. But there's going to be a lot more scrutiny now. Now there's going to be expectations. There's large investors are now going to be looking at it, researching it, seeing if it's worth investing in for the long term. As we've seen, I mean, from 2019, this is the Excel where I was just kind of looking at some of the financials, just kind of breaking down where they're making the revenue, where most of their expenses are. But I mean, from 2019 and on, I mean, we've seen this company just growing significantly. In 2019, it was $82 million. Now it's $872 million. I mean, it didn't take very long to get to this point, and this growth is going to be expected from the market. Just because they're added to the S&P 600 doesn't mean they can sit back and just relax. Now is when the expectation is going to be coming from the market for the company to actually perform and continue to provide services and scale horizontally and vertically, providing new treatments and coming out with new products. As you see, I mean, 2022, I mean, we've seen the company grow revenues 80%, 82%, 93%, 65%. I mean, when a company is just growing this fast, we're going to see investors just wanting a part of this company because they see this growth. I mean, most of the revenues, as you can see here, is coming from online. 90+% of the revenue is coming from their online sales. So they're going to have to keep scaling this online sales. They are very digital, so that means they're going to have to keep growing this online business and continue growing this online revenue. As you can see, their online revenue has definitely grown from 70, 80, 90, 60, almost 70%, and they're gonna have to keep growing this. This is their gonna be bread and butter, their online sale. Obviously they have their wholesales, right? They got their Targets, their Walgreens, and other partners in the market that they sell wholesale their products to, and that's also growing. I mean, I can see this growing as because now the part of the S&P 600, you may see this wholesale actually increase because now more and more companies are going to be aware of them, and their online sale is going to grow because more and more people are going to know about them. Subscriber numbers, right? So there's subscriber numbers are growing 60, 70, 80, 47. I mean, the subscriber numbers are still growing. I mean, 4-year KIGAR here is for about 50% growth, which is phenomenal to see. They're gonna have to keep growing their subscribers, and I think this is gonna grow exponentially. Now that there more and more companies going to be aware, this awareness is going to help them gain some subscribers. Cost of revenue. Now, their cost of revenue is, as you can see, definitely growing. So this is always how it works. As the company grows, they're gonna have more fixed costs that is associated with doing that business. And so this is expected to grow. I mean, this growth is not that bad at all. But their gross profit, is what, 99, 74. I mean, this company is growing gross profit at what, an average of let's look at the average growth of we're looking at an average growth of what 101% of gross margins. I mean, this is phenomenal. I mean, the market is gonna love this. They're gonna see these numbers, and they're gonna jump on the company marketing. Now, this is the part that most people and most investors are gonna be disappointed at seeing. As you can see, starting in 2021, I mean, they were investing what $136 million in marketing, and this continues to grow 100+% in the past. 2021 and 2022 has gone down. The growth has slowed down a little bit, but they need to watch this, and investors are going to be watching this closely. I mean, they are an online-based company. They're going to have to market themselves and try to get the biggest market share by investing in marketing and getting their name out there and having people recognize them, know who they are. But they need to also be careful with this marketing expense. Otherwise, this is gonna be take toll on the company's net income, and investors are gonna be kind of very skeptical of, like, is this company only going to grow due to marketing, or are they going to have this natural growth from customers recognizing them and just getting good brand awareness outside of marketing? I mean, general selling administration, I mean, all of this, none of this looks extremely insane. This is just part of doing business, paying bills, paying employees, paying research on whatever it might be. Technology development, I mean, we can definitely see this grow even more as they're a technology heavy company. So as you can see, I mean, their total operating expense definitely starting to take off significantly here, and this is where, I mean, you start noticing their expenses is due to this marketing expense that I talked about. So if they don't watch this marketing expense, I mean, this total expense number is just gonna keep going up, and this is where the company is going to be hurting a lot. As you can see, I mean, the company made a revenue gross profit of what 2021 they made 204. They're negative $115 million in operating loss. Then the operating loss decreased. So this is not bad at all, as long as the company keeps this trajectory, as long as they continue getting into that profitable zone where it's not all red, and they slowly just, I mean, here in 2023, I mean, they lost $30 million in operating income, but that's okay. They're investing, they're growing, and they just have to watch out for that marketing expense. So this is the overall, like, really good for the company, for a young company, and this investors love seeing the decrease in this marketing expense. Let's move on to total other income. So I mean, they have other income. This isn't, I don't know exactly what this income is. This isn't your main bread and butter of the company, but they are getting some peripheral income on the side, whatever that might be. So this is net income. So at the end of the day, the company is coming out with what? Better net income, net loss, I guess. I mean, they're still losing money, but overall, like, we want to see this decrease in the loss. So we want them to lose less money year over year. I mean, when they report in 2024 earnings, potentially we may see some positive numbers, maybe even zero, which would be amazing. From a company operations perspective, they're not doing bad at all. They just have to be careful, like I said, on that marketing expense. Now they're going to be scrutinized very closely by investors, and they're going to have to watch out where they're investing this cash. They're going to be able to go to investors and ask for capital to which then they can use to invest in themselves, invest in growth, invest in research. This is going to give them the opportunity to continue the current momentum that they have. It's important to note that while inclusion in the index often brings positive attention to the company in the short term, but in the long term, they're going to have to keep operating in a better format. Their fundamentals are going to have to look good. The business performance and growth perspective must look good for companies to want to continuously invest more and more money, and maybe eventually for them to get out of this S&P 600 small cap and actually join the S&P mid cap 400 with time. I'm imagining this is going to hit $20, $21, $22, at least hit 20, definitely hit 20, $20, $22, $23 a share going into Wednesday, and then kind of see like a plateau, or then see that equilibrium price by the time Wednesday comes, and just kind of settle in the 20s, probably somewhere in the 20s. But yeah, that is my analysis. That is my outlook on the company. If you enjoyed this video, make sure you subscribe, make sure you like. I'm going to be posting more videos about HIMS and probably other stocks as well. If anyone has a question, go ahead and leave a comment. With that said, peace.